Good evening and welcome. I'm Wendy Brennan and I organize Senator Krueger's educational events. Senator Krueger is sorry that she couldn't be here this evening, but she sends her best wishes. So I'd like to welcome all our attendees who are viewing this event on Zoom and Facebook, or who are calling into our virtual town series about income taxes. As always, we have closed captioning for today's event. And as a viewer, you have to activate closed captioning to view the text on your device. If you're in Zoom, click on Live Transcript in the meeting controls to start and viewing closed captioning. If you're in the Facebook Live event, you'll see a settings button in the bottom right-hand corner of your video. Click on CC for closed caption to activate the process. Now, this forum is being recorded, so everyone who RSVP'd will receive a link to the event video, all the resources that we list in the chat, and the presenter's PowerPoint. And before we begin tonight's program, I wanted to give you a COVID update. I know that many of you have heard that we are experiencing a COVID surge, and while it is not as severe as past waves, people are still getting infections and hospitalizations are rising. So to help avoid getting COVID, you want to take some precautionary measures, such as wearing a mask in public indoor locations and around large groups of people. But the best way to protect yourself from COVID is to stay up to date with your COVID-19 vaccines. The 2023, 2024 updated Moderna and Pfizer COVID-19 vaccines have been approved for everyone 6 months old and above. And for adults, you have to wait at least 2 months since your last COVID vaccination to get the booster. Resources to help you find vaccine sites and how to make a vaccination appointment are being posted in the chat. Our office has been informed that insurance providers, and that's including Original Medicare, Medicare Advantage, and commercial health insurance providers, are working on updating their systems for billing purposes. It may take several days before this process has been completed. So please contact your health insurance provider before you get the vaccine to make sure your vaccination will be covered. And now we are going to move on to today's event. So today's town hall is the second of our three-part financial roadmap series. And to guide us through our journey this evening, we have two experts from the Financial Planning Association of Metro New York. Tonight's session is titled A Brief Overview of How Much Tax You Pay and How to Manage Your Taxes Effectively. Our presenters this evening are Stephanie Chau, and she is a certified financial planner, a CPA, and she is here as a representative of the Advocacy Committee of the Financial Planning Association. Joining Stephanie is Anja Luesink. She has her MBA, and she's also a certified financial planner. And she is here tonight also as a member of the Advocacy Committee. And now it is my pleasure to introduce Anja and Stephanie. So please turn your cameras on, unmute yourselves, and we are going to turn it over to you. Thank you.
Thank you.
Well, thank you, Wendy. Anja and I are delighted to be here as members of the Financial Planning Association. The FPA is a leading membership organization for certified financial planner professionals and those engaged in the financial planning process. We're both CFPs and love to share our thoughts on financial topics. Tonight, we're going to talk about income tax planning. We have a lot of charts, and I'll try to keep it simple. I'll take you through the presentation, and Anja will join in when she feels like she wants to share additional comments. So let's get started. So first, I want to talk about why do we pay taxes? Taxes provide revenue for federal, local, and state government to fund essential services such as defense, highway, police, and a justice system. Taxes also fund programs and services such as education, health, social services, job training, schools, and parks. And taxes also we contribute to that towards our Social Security benefits during retirement. So next, we're going to talk about how much tax do you pay. And I like to give you an easy example. Let's take Mike and Susan as example. They're both 62 years old, and they plan to file joint return at end of 2023. In my example, they will be making total of $150,000 in salaries. So if you look at their total wages I have over here is $150,000. And first, they will get standard deduction. For federal, for joint couple, they get a standard deduction of $27,700, which means the first $27,700 they earn, they don't have to pay any income tax on. And next, we're going to look at the marginal tax rate. So the way it works is the more income you earn, the higher taxes you pay. So if you look at my chart, for example, the first $22,000, you pay income tax rate of 10%. And then the next, from $22,000 to $89,450, you pay a marginal tax rate. You pay a higher income tax rate at 12%. So over here, I walk through an example where the first 20,000 I applied a 10%, and the next 67,000 I applied a 12%, and then the following 32,850 I applied a marginal rate of 22%. So when you go through this example, I arrived at estimated taxes that they will have to pay, which is about $17,000. So what does that mean? So if you take the total $17,000 taxes they have to pay, divided by their taxable income, it arrives at 14%. So which means on average, they're paying tax of 40% for their, at a federal level, they're paying 14% on average on their taxable income, which is not bad. So on next slide, I will show you where I got the federal standard deduction from. As you can see, the federal standard deduction is inflation adjusted. So this year's number went up approximately 7%, which is good news. The higher the standard deduction, the lower taxes we pay. So you can go through the numbers at your leisure. I do want to point out, since we have many retirees joining us tonight, for people who are 65 years and older, they get additional $1,500 when they file the joint return. For a couple, each of you get additional $1,500. And next, I will show the federal income tax bracket. So this federal income tax bracket breaks down by married, filed jointly,
Single, and head of household. I think Stephanie has some internet.
and head of household. In my example, Mike and Susan, I took the I'm sorry, can you hear me?
Yes, you were frozen for a moment.
Okay, I'm so sorry. Yeah, it looks like
Okay.
for some reason it says I have a stable internet for some reason. Okay, let me just continue. Thank you, Anja. Okay, so you can review the slide at leisure. I just want to share with you, these slides are here for you. And okay, and let's continue with our example. Let's say Mike and Susan are New York City residents. How much additional taxes do they need to pay? They will need to pay New York State and New York City taxes. So let's continue with the example. We're starting with, they have a standard deduction of $16,050. So people actually can take either the standard deduction or the itemized deduction. But nowadays, because the standard deduction are so large, most of the time it works out better to use the standard deduction. Therefore, I'm just using this as example. So in my case, I am arriving at $133,000 of taxable income. And if you look towards the right, you will also see the New York State tax bracket. It goes from lowest of 4% to highest of 10.9%. Most people will probably fall the range from 4 to 6%. And again, from the left side of screen, I have worked out my numbers. And basically, again, I take the 4% and apply to the first 17,150. And then 4.5% to the next 6,450, and so on and so forth. So after I do the math, I basically come down to, for New York State, they'll have to pay approximately $7,000, which works out to be approximately 5.53%. And for New York City, they're expected to be paying approximately $5,000, which works out to be 3.71%. So in total, you can see for Mike and Susan's example, the total New York State and New York City tax is approximately 9%. So it's quite a bit. So what we want to do is, before I go to share how we might save some taxes, I'll just quickly go over the New York State standard deduction. So New York State standard deduction, they're not subject for inflation. So it's pretty much the same every year. They might have a small adjustment here or there. But in 2023, the standard deduction is the same as last year. In my example, married filed jointly is $16,050. And you can look at other ones at your leisure. And also here is the New York State income tax brackets and rates for married, filed jointly, single head of household. And the next slide, I have included information for New York City. So at the end of the presentation, you'll be getting the slides later so you can review all these tax brackets at your leisure. So next slides, we're starting to get something more exciting. What we want to do is look at different retirement income categories and offer some thoughts on how to save taxes. So if you look at this slide, there are many income sources you can withdraw from. So as many of you have worked so hard in the last 30 years or so to save money for retirement, I would say congratulations, you have a lot of options. You can withdraw money from money you have saved through work, or if you saved in your IRA accounts, you can withdraw that as well. And most of you will have Social Security benefits, and some of you will have investments as well. And others might continue to work during the retirement. So let's look at different retirement accounts and let's explain how they are taxed. So for example, if we look at 401k, 403b, so these are the money when you put in during your work. So for example, in our case, let's say Mike and Susan, if they wanted to lower their income taxes during 2023, so they could put money in their 401ks and the tax deferred 401ks, and then that will help them lower the taxes. So again, so the tax deferred accounts just means when you put the money in, you have not paid the tax on that money. So when the money comes out, everything is taxable at a federal level. And at a federal level, they're taxed as ordinary income. However, New York State is relatively generous. For those 59 and a half and older, the first 20,000 of retirement income from a corporate pension, IRA, 401k, or another retirement plan is tax exempt. A married
Shall we wait for a moment? Or shall
let's give
$40,000 exemption. So that's great.
You were gone for
I'm sorry.
So should I continue?
Am I back?
Yeah, now you're back.
Okay. Can you hear me?
Yeah. Continue.
Anja, I'm so sorry. Am I back?
Yes, you are back.
Okay, I'm so sorry. So Anja, in case I get stuck again, I might well have you continue the slides.
Yeah, I was wondering whether I should step in, but it's okay. I'm glad you're back.
Okay, thank you. So for the Roth IRA accounts, Roth 401 accounts, and Roth 403b accounts, all those accounts, when you put the money in those accounts, you have already paid the taxes for those accounts. So therefore, when you take the money out, they're tax-free. And also the money that you earned in those accounts are tax-free as well. So that's a huge, huge benefit. So let's ponder for a second. If you have $100,000 in your traditional 401k accounts versus $100,000 in your Roth 401k account, which one worth more?
I think
the answer
401k.
is
I think the
thank
401k
you.
account, the Roth 401k.
Thank you, Anja. And the reason is, like I mentioned earlier, the Roth 401k, you already pay taxes, go into the account, and all the money come out. You don't need to pay any taxes on. And just for budgeting purposes, so let's say if you have money saved in the traditional 401k, so you want to take out slowly, you want to spread over a period of time. so you don't pay a lot of taxes at one shot. And also for budgeting purposes, perhaps you can say, okay, I want to save 25% aside in case I need to pay taxes. And let's look at Social Security, for example. Social Security benefits at a federal level, it's up to 80% of your Social Security benefit may be taxed at ordinary income rate. And at New York State level, they don't tax on Social Security benefits, which is wonderful. So let's see how the Social Security, let's go into a little bit in depth, how they come up with the numbers. So the way we figured out how much potential taxes we need to pay on Social Security benefit is we look at the provisional income. And I have write out the formula over here. Basically, you take half of your Social Security benefits, you add non-taxable interest, and then you add all of your other income. That's how you come up with your provisional income, your total provisional income. And then you say, so let's look at Mike and Susan, for example. In Mike, Susan's case, I mean, they're not taking a Social Security benefit yet. But let's say if they were taking out Social Security benefit and their total income tax is greater than $34,000 over here, which means up to 85% of the Social Security benefit could potentially be taxed. And I also want to highlight one thing. For married, file separately, and for spouses live together at any time during the year, you're getting a little bit of penalty. So for those who are married, file separately, and the spouses live together during the year, up to 85% of their Social Security benefit is taxable. So if you look at the provisional income, you say, okay, the taxes on the Social Security benefit is not only just looking at your Social Security benefit income alone, it's looking at all your incomes plus your non-taxable interest. So we have to be mindful of how much income, how much taxable income we have each year. The higher the overall income, the higher percentage of your Social Security benefit will be taxed. So that's the exact reason we want to take income sources from different accounts, and the goal is to lower your overall income tax. And let's look at the next slide. The next slide is a great benefit to many of you. The federal government offers lower tax rate for long-term capital gain. In New York State, unfortunately, do not offer that benefit. They're just taxed as ordinary income. Sorry. Okay, let's explain what is capital gain. So I have write down an example over here. Let's say we bought a stock. We bought 100 shares of stock A back in January 1st, 2015. We paid $50,000. Let's say on January 1st, 2023, we sold that same 100 shares for $100,000. in this example, you take $100,000, the proceeds, how much you sold it for, you minus how much you paid for, you have a gain of $50,000. So we call that is capital gain. Now, what is long-term capital gain? In our example, we bought it on January 1st, 2015. We sold it on January 1st, 2023. We held more than 1 year. In fact, we held 8 years. So anything that's greater than 1 year, that's called long-term. So in my example over here, we have a long-term capital gain. And let's see what the tax rate is for long-term capital gain. So I'm going to go to the next slide. Okay, so here's another one where your overall income, your overall taxable income come to play. So for 2023, let's say your overall income, including everything, is under $89,250. That means your long-term capital gain will be taxed at 0 rate. That means you don't have to pay any income tax on the capital gain. So that's why, and then if we look at, let's say if our overall income tax, so this, I'm using this as married couple file jointly. So let's say someone is at, their income is between 89,000 to 553,000. Then they're going to be taxed at 15%. And then if they make even more, then they're going to be taxed at 20%. So therefore, it's always important to think about your overall taxable income for the year and take a step back and say, okay, I need X dollar amount for retirement. And where should I take some money from? You take some money from your, pre-tax dollar, like the deferred, and you might take some money from Roth, because by taking money from the Roth account, it's not going to be increasing your taxable income. So these are the things I will like, people to be mindful of. And given the time constraint, I'm highlighting these examples, and I'm also having some of the helpful resources for you. So for example, the federal income, the IRS.gov have great resources about federal income tax. And also on the IRS website, they have tips for seniors in preparing their taxes. And if you look down, you have New York State income website. And it's also a fantastic place to research about your New York State income taxes. And also I want to share, you will find many helpful resources under the aarp.org website. So feel free to do additional researches on these websites. And I also have a few additional informations. So for example, IRS also have, you can also file free using some of the tax softwares where IRS have a partnership relationship. It's for qualified taxpayers, those people, their income is under certain threshold. And also additionally, New York State also have some of the free filing softwares and tools you can use for qualified taxpayers. And this is for the IRS government. They also have free resources. They have, for example, like the volunteer income tax assistance program. They also have tax counseling for elderly. So there are many resources you can use. So I'm going to turn it over to Wendy for Q&A session.
Thank you so much, Stephanie. That was great. And we have a tremendous amount of information. So I just want to reiterate, there was a lot of information. There are a lot of resources. Everyone who RSVP'd is going to get a link to the video recording. They're going to get a link to all the resources that are listed in the chat. I know that somebody asked how do you copy that, but we'll have it for you in a few days. And we also will give you a copy of the PowerPoint, which was terrific. So there's a lot of information and it will be available to you. So I think that you probably answered this. And if you do have questions that come up now, please post them in the Q&A, either in Zoom or in Facebook. But I just, there was a very general question that somebody asked, and I think you did a great job of answering it, Stephanie. But do you have anything you want to say about how the best way somebody can file their taxes? But before you do, I just want to remind people that if you're an older adult, you can certainly get, and you're low income, you can certainly get free tax help during tax time. If you don't know where to go and you live in the senator's district, we can definitely call the office and we can give you the closest preparation place. But Stephanie, is there anything else you wanted, any other pointer you just wanted to add about this?
Sure. So if someone's taxes is relatively simple, and if they don't fall below the threshold to using the federal or New York State free tools, you can use, there are many softwares out there. One of them that I use is TurboTax. I find it's relatively easy to use. However, it's always a good idea to read all the instructions from the federal tax instructions form and New York State instructions form. That way you have a general idea when the tax return it's printed from TurboTax or another software, you have a general idea whether or not those numbers looks reasonable.
Thank you. So somebody wanted to know that if they are working and they have a quote unquote 9-to-5 W-2 job, can they deduct expenses from a side gig that they have on their taxes?
Okay, that depends. So if the purpose of the side gig is making profit, the answer is yes. IRS look at 9 different factors. The most important one is the intent is to make profits, and they do run the side gig as a real business. They keep track of incomes, they keep track of expenses, they have knowledge to make this as a profitable business. What IRS doesn't want people to do is simply just for people write off expenses. So you could not continuously show losses year after year. Then they will disqualify you. Then they said, okay, it's really a hobby. it's not a business. So the answers depends.
Yeah, and I want to add that in the case that you really have a business, the IRS understands that the first few years, 2 years, whatever the amount is, you might have more expenses than income because it takes time to build it up. So you can deduct that, but it has to be a real business.
So be probable if you're going to have a side gig. I guess that is the lesson we can learn from that. So the next few questions are very nuanced, but I will ask. They're about required mandatory distributions, or RMDs. So I'm going to ask you what the tax implications for RMDs are for already retired people.
Okay, so if they are referring to, so for example, the required minimum distribution, now it's being delayed from 72 to 73. In that case, it's really only impacting those who are age 72 this year. So normally, if we didn't have the Secure Act that was recently passed, so let's say you would normally take it at age 72. So giving it delayed to age 72, at age 73, so you don't need to take retirement distributions this year. You can wait until next year. And I think Anja will have some additional input as well for the retirement.
Yeah, what are the implications of our required minimum distributions, or RMDs? Means that when you have to start taking them, they come on top of the income that you already have been receiving. So they come on top of your Social Security income, and maybe income from work, maybe income from investment accounts. So it will just increase your taxes. But that is also, I mean, that's why the government wants you to take required minimum distributions, that at a certain point, they will receive tax what is previously deferred.
Great. So I'm going to take some new questions now. First question we received this evening: is the Roth IRA withdrawal added to your IMRAA and capital gains tax rates?
Oh, the IRMA. The IRMA, that is, oh, I always forget what that is.
We don't know what that is, so tell us.
No, that the IRMA is, what does it stand for? It is the premium that you pay based on your income for Medicare. So Medicare has a premium that is, I think, for the lowest income, the normal is $164. If you have a higher income, and there are, again, tax brackets that I don't have in front of me at the moment, you pay a premium. And that premium that can go up from $70 to $164 to $300 to $500. So if you have a high income and you are on Medicare, you pay for Medicare Part B a higher premium. That is also the case for Medicare Part D. That has also an additional premium on top of the regular premium, income-based.
Okay, great. And so somebody
What
wrote,
was the question? I forgot what the question was, because this is explaining what it is.
That explains what it is. So they want to know, is the Roth withdrawal added to the IRMA and cap gains tax rates?
No, the Roth withdrawal is tax-free. So that will not be adding to your taxable income.
Great, thank you. So somebody wrote, I'm curious why you break down the income and use different percentages according to the ranges rather than using 1% for total income?
Which table are we referring to?
Yeah, I don't know. It wasn't put in there. But let's move on then. I don't know.
Yeah, that is the
So-
government decides, so it's not us.
So how do you find a reputable accountant? We always get questions how you found attorneys, accountants. What would you suggest?
Well,
Do you suggest they call the Financial Planners Association or?
perhaps, I don't know if they keep track, like, so you can look at their credentials. Usually people who are certified public accountants, that means they achieved a certain education level and work experience. So that's helpful. And then they also have like enrolled agents. Those people have passed, they studied income tax return, they have passed certain exams. So I think those credentials will be helpful.
This isn't particularly scientific, Anja. I don't know if you have anything to add, but this is something you can ask your friends, your colleagues, your neighbors who you trust, who they use, if they like them. I mean, that is always a good way to either get a family lawyer or an accountant, is just to do it through word of mouth. Not very scientific, but that has been like a good experience. For me, I called a friend who's an attorney to get a family lawyer, and that's how I did my sort of preliminary estate planning.
But it's also good to look at the credentials. That's certainly important.
Absolutely. Yeah. So how do you minimize your tax liability and bequeathing and passing on the family home to a child?
Okay, this is a complex one. And the reason is because I do not know the value of the home, and I don't know how big that person's estate is. So this one, I'm gonna defer that question. I think it'll be helpful for the person to see their, estate attorney and their own accountant, so that way they have in-depth knowledge of their personal situation and plan accordingly.
Okay, thanks. So I'm going to read this one. It's a little long, but I have been invested in a mutual fund, S&P stock index fund, for many years. So in both 2021 and 2022, the fund manager sold a lot of the shares, resulting in huge capital gains, which resulted in their federal income tax return showing an adjusted gross income of 50% higher than in past years. So is there any way to prevent this tax event in the future other than selling out this fund?
Okay, this is one of the disadvantages of owning mutual funds. So when you own mutual funds, you cannot control what type of capital gain distributions they make at the end of the year. So unfortunately, because of that, it makes, like in this example, it basically it makes the tax planning very difficult. So one of the things that someone can consider is to invest in exchange traded fund, which is called the ETF. And then you do not have that problem. When you sell your ETF, you have, capital gain or capital loss. So you get to decide, as opposed to mutual funds, the portfolio manager get to decide.
Yeah, I want to add that this is more of an investment matter, and next week there will be an presentation about investments, and I'm sure that they will go into this. I also want to say exchange traded funds is actually a mutual fund that is an index fund that invests in a certain index like the S&P 500. And there are also mutual funds that do the same, but the exchange traded fund trades differently. It trades at a mutual fund trades once a day at the end of the day. And an exchange traded fund trades during the day. You can, it trades as a stock. You can see anytime what the price of the ETF is. And the structure is different than a mutual fund, so that's why it is more tax efficient for distributions.
So, Anja, if you can just post the name of the fund in the chat, just write it in, and if not, if you can't do that, then we'll put that on the resource page for those who RSVP.
It is not a specific fund. This is
okay.
A type of fund, just like a mutual fund.
And right, so repeat the name for folks just one more time.
Yes.
The exchange
traded fund. I just typed it in to be seen.
Oh, great.
Yeah.
Great.
Exchange traded funds, ETF. And that's something you read about a lot, so it's good to know.
Right. So what are, I know, Stephanie, you covered, the difference in tax rates between a single person and a married person and decisions about filing. But somebody asks, what are the tax implications for someone who has been single and then just gets newly married?
Yes. Okay. So let's look at two individuals, and let's say they're both high income earners. By combining their income together, it will put them in a higher tax bracket. So that's why it's actually called a marriage penalty, unfortunately. And in another example, where if you put two low income earners together, so let's say if that one person would normally qualify for certain benefits or certain credit, and when you add the two people together, it might put them over the limit, so they'll get disqualified for certain credit. So under those circumstances, when you combine both high income earners or both low income earners, you will actually get a tax penalty. So what works well is if you have someone who is a high income earners and maybe a low income earner, that way your tax kind of get averaged out. It kind of lowers your taxes. So one of my friends, this is what she does. So she will often prepare, just for comparison purposes, so she will prepare a joint return, and then she will prepare married file separately. And then she will compare which one works better. Is it married file jointly works better, or married file separately works better? And sometimes when you have two high income earners, you might find married file jointly, it might work better. So unfortunately, you have to do this exercise of, preparing the tax returns and compare and decide accordingly.
Thank you. So I know you felt that you had to go to an accountant for an estate sale of a home. But if somebody has a co-op apartment and is still living and sells that, what about the taxes on the gain on the sale of that co-op?
Okay, so actually, so let's say for a couple and they have lived in that co-op for more than 2 years. So they have to satisfy both the usage. So Anja, help me out. So you have to meet
they are
the two
eligible
tests.
so there is a certain capital gain if you sell your apartment in a co-op or a condo, and you are eligible for an exemption, and that is for one person 250,000, and for two people it's 500,000 if you lived in the apartment for a certain amount of time.
Okay. And does the apartment being your primary residence impact that?
It has to be your primary.
It has to be the primary, resident. They have to meet the use test, and there's one more test they have to meet. So it's like 2 out of 5 years. So that's, many people, when they retire, they might move somewhere else. And so for a couple, they get, $500,000 exemption.
Okay, so time always flies when you're having fun. I'm going to ask one more question and then I'm going to wrap up. So the last question is, you've seen that the Roth IRA had considerable tax advantages. Can you switch from a traditional IRA to a Roth once you've put the money in?
Yes.
Yes.
Go ahead.
Okay, and can you do that even after your retirement age? Is there any time you want, you can switch that?
Well,
so
okay,
that when you
okay. So let's take one step back. So when you switch, because the traditional IRA, you have not paid money, you have not paid tax on that. So when people say switch, in fact, they are basically say, I'm going to pay tax on that money, and then I can put in the Roth account. So some people say this is like a backdoor Roth, or sometimes you can do it legally. Like, I mean, they're both legal. Sometimes it's backdoor, sometimes you can just convert, but you have to be mindful.
You have to do a conversion. That is very important. You cannot withdraw money from your IRA and then later put it in the Roth IRA, because the IRA and the Roth IRA have a certain annual limit that you can put in it. But a conversion you can do anytime, and as long as you pay the taxes on the IRA and then you convert it to the Roth IRA, and that can be done before retirement and after retirement. We often advise our clients to do that when they are, for instance, a number of years in retirement and have a lower income than that they currently have. And sometimes it's before they start taking their Social Security. So they have a number of years that they only withdraw from a brokerage account before their RMDs. And then we advise them to do this conversion. Yes.
Right. And I also want to add a technical point, because let's say if you have $500,000 in your traditional IRA, and let's say if you want to convert $5,000, it's not so easy to do, because it's looking at, like, when you do the conversion, if you have money in your existing account, it's saying like when you convert 5,000, it's like you're really converting 5,000 as a percentage of $500,000. So you can never achieve that. So what some people do is, if they want to do that, they have to first bring some of their traditional IRA. If they're at work, they can bring it into their 401k, so they don't have any traditional IRAs in that account, and then they can start clean contributing, let's say in a traditional IRA, then they can convert it over. So there's a little bit of technical thing you have to follow. So it's not as easy as 1, 2, 3.
Yeah, for a direct conversion from a 401k to a Roth IRA is usually what a brokerage firm or does not accept. They want to have it be put in an IRA, which is so you do a rollover from a 401k to an IRA, which is tax-free. There's no taxes involved. It goes from a tax-deferred account to another tax-deferred account, and then you will convert it to a Roth IRA.
Okay. So unfortunately, we are running out of time. Sorry, we didn't get to your questions if you asked them, but I want to thank both of you so much. This was such good information, and very much appreciated. Yeah. So I just wanted to give you a few notices before we sign off. So this Thursday, September 21st, we'll be sponsoring a virtual SCREE event from 7 to 8:30. And next Tuesday, as I think Anja mentioned, September 26th, we will have the last session of our financial roadmap series, and it's the power of investing, stocks, bonds, and alternative assets. And we're putting the link to that in the chat. And so if you haven't signed up, you can. I want to thank our speakers again. I want to tell everybody to good night. Stay safe, mask up in indoor places, and wash your hands. Thank you.
Thank you.
Good night. Thank you for having us.